A single political standoff has just sent a warning signal through the global energy market. And if you think this is only about a rejected ultimatum, you're missing the real story. Because when Donald Trump pushed for a hard realignment of North American energy power, the expectation in the financial world was simple: capital would follow politics. But when Mark Carney stepped back from the table, and the projected $865 billion energy framework began to fall apart, something much bigger happened. The future pricing of energy just changed. To understand why this number is so explosive, you have to understand what was inside it. This wasn't a single contract, this was decades of infrastructure: LNG export terminals, cross-border pipelines, hydrogen corridors, carbon capture networks, grid modernization, and the financing structures behind them. Pension funds, sovereign wealth funds, private equity, and global banks had already started modeling the long-term cash flow from these projects. In other words, this deal wasn't just about energy production. It was about predictable returns for the next 25 to 40 years. And when predictable returns disappear, markets panic. Because energy is the most politically sensitive asset class in the world, the United States wanted strategic control, more domestic production, more leverage over allies, and the ability to use energy supply as an economic weapon. That model strengthens the dollar, supports U.S. shale producers, and keeps global trade flowing through American influence. Carney's vision represents something very different: a financial system where climate capital decides the direction of energy, where investment follows ESG frameworks, and where the biggest pools of money move toward decarbonization, not fossil fuel expansion. So this wasn't just a negotiation failure, this was a collision between $2 trillion economic systems, and the markets immediately started asking three questions. First, where does the stranded capital go? Because the money that was supposed to build pipelines and LNG terminals is still sitting inside institutional funds. That capital now needs a new home. And when that kind of money moves, entire sectors rally. That's why global clean energy indexes, transition metals, and European grid projects suddenly become more attractive. Second, what happens to North American energy dominance for the past decade? The US and Canada together formed one of the most powerful energy supply chains on Earth: oil, natural gas, uranium, hydro. The combination gave them pricing power. If that coordination weakens, the market starts looking to new suppliers, and that means opportunity for the Middle East, opportunity for emerging LNG exporters, opportunity for countries building rare earth and battery supply chains. Third, what happens to inflation? Because energy prices are not just about fuel. They are the base layer of every economy. If long-term supply expansion slows down, future energy becomes more expensive. If future energy becomes more expensive, central banks cannot cut rates as fast as markets expect. And suddenly, what looked like a political disagreement turns into a global interest rate story. This is why traders are watching energy futures more than political speeches. Because the collapse of an $865 billion framework doesn't hit today's gas price. It hits the 5-year and 10-year outlook. And that changes everything from tech stock valuations to real estate liquidity. Now here's the most important layer for your viewers. Geopolitics today is not about land. It's about capital alignment. Who finances the energy transition controls the global economy. If the US model dominates, fossil fuel strength, domestic manufacturing, and resource nationalism come back to the center. If Carney's model gains momentum, global green finance, carbon markets, and climate-linked bonds become the new oil, and every investor on the planet has to pick a side with their money. Watch the institutional signals. Watch where BlackRock-style long-duration capital flows. Watch sovereign wealth fund partnerships. Watch which currency strengthens alongside energy investment announcements, because that's where the real power shift is happening. This moment may look like a broken deal, but in financial terms, it's the repricing of the next energy era. The winners will not be the loudest political voices. The winners will be the countries that attract the redirected capital. And the investors who understand this early will position themselves before the next $1 trillion build-out even gets a headline. So don't see this as a diplomatic clash. See it for what it really is: a signal that the global energy map is being redrawn. A signal that long-term money is changing direction. A signal that the next cycle of wealth creation has already begun, just in a different place than the market expected. And if you follow the money instead of the politics, you won't just understand this story, you'll be ahead of it.